Welcome to another edition of our recorded webinars here at Altus Group at the Real Confidence page. Again, Real Confidence is a regular publication sponsored by Altus Group, the National Association of Real Estate Investment Trusts, and the National Council of Real Estate Investment Fiduciaries. We have a great guest, friend and a colleague today, Jorge Paredes, who is a CFA, manager of our Chicago office. Again, with Altus Group. Welcome, Jorge, to join us today. Thanks for taking the time.
Anytime, Chuck.
Today, we're going to talk a bit about our attribution analysis, and Jorge is a specialist in that area. This is a new tool that we've added to the Real Confidence website. And I'm going to show you briefly. We're going to go over the basics to start of where this is at. And you just more or less move to the university section. If you want to start there, this again is a combination of the executive side, which is our sentiment survey for 2017, and then the university side. Now, all of our university participants should be pretty aware that this is where the 2017 competition sits, and you can get to the other challenges through the All Challenges website here. So if you're in the 2017, you can see it on obviously where we were at before. The 2016 is over on this side here, where you can get these returns and so forth. For the actual attribution and all the other tools that we're slowly introducing to the site, you actually have to go up to this tools section at the top. The tools here, you can see the data center. This is where you can get all of the data for the benchmarks for your selection. We have portfolio visualizer. We're going to be doing another webinar on the portfolio aspects. This is where you can do backup testing of portfolios, efficient frontiers, things of that nature. And today we're going to talk about the attribution analysis with Jorge. So all you have to do is click right here, and this gets it started. So a lot of components to the actual attribution analysis, and we're going to try to simplify this the best that we can for this kind of 101 class. The choices you have at this point are going to be the 2016 competition. We're waiting on data from NACREIF and the Gilberto Levy Index to get updates for the third quarter, technically the third quarter of 2016, and also the first quarter of 2017. When we get that data, we'll have more updates, and you'll actually see 2017 competition as a selection for the attribution as well. But today we're going to focus on the 2016. So we're going to focus mostly on the second quarter. And here you can actually select what quarter you want to talk about. So if you want to speak just of the second quarter returns, for this point, you just select one quarter. And today we're going to use DePaul University, not because we think they're the favorite. We just have it like their portfolio, and it's a little bit more diversified, so we have some more options to discuss. So again, we're going to just look at one quarter, which is the second quarter returns for the 2016 challenge, just for DePaul University. And to start off at the highest level, these are the quadrants of commercial real estate investing. This is where you started, if you remember, when you made your selections to the portfolio. Again, REITs or public equity, you have private equity, public debt, and private debt. And you can see in the DePaul portfolio here was their allocation of the $1 billion. So they went $600 million on the private equity side and $400 million to the REIT side overall. That's obviously here where you get the fund breakdown. And this here is the index allocation. Now, if you recall the index, when you look at your competition and you look at the returns, you'll see that there is an index called the University Index. And it is the aggregate of all the selections that all the students picked by teams. So for 2017, it is an aggregate of 38 portfolios. For 2016, it is an aggregate of 32 portfolios. So that's where you can see this allocation here. And this is more, 74% went to the REIT side in sum. This is the delta. It's the change between the two. And then you get into actual total returns. And we'll get to that in a second. When you look at this, you can actually select the breakdown of the quadrants. And when you break them down, you can get into even more detail on how the allocation happens. So in this example, they went $75 million or 7.5%. To industrial REITs, which was less than what the aggregate was, again, for the Real Confidence University Index. And when you look at the funds are really the breakdown of the returns that you have from all the indexes that are linked to all these different selections. So let's click on private equity and take a peek at them as well. And you see that same thing, the allocation breakdown, the total return of those selections, and the total return of the index, which is the same because they're linked to the same benchmarks. I think that's the best way to kind of sum up those aspects of the choices. Again, here's the debt too. There's no allocation to debt, so we're not going to select on those today. But before we get into the attribution and discuss this in more detail with George, maybe we just start off with more of a broad question, George, and we kind of say, what is attribution analysis and what is it really used for?
So attribution analysis really, it's really the ability to, you're analyzing and measuring the ability of your portfolio and your fund managers. So there are various forms of attribution out there. What we're using here is a micro attribution where we're really splitting it up and we're measuring two components, two major components and then a residual component. You have your selection effect, which is basically measuring your ability to select between different sectors. So in the portfolio management world is your strategy. And then there's a selection effect, which is really a measurement of your actual property. In the real estate world, the measurement of your property's performance in relationship to the benchmark. And then mathematically, there's always a residual, but the two main components are the selection and the allocation effect.
Okay, great. I see, when you look at this, you got this graph off to the right, which we're going to discuss, which could be maybe a little overwhelming, but we're going to break that down for everyone. And you see a lot of different coloring across the board. It's pretty simplified when you see this color here. It's obviously a negative or less than, so this change is less. You had less allocation in equity REITs here than you did as the benchmark. But when we look at these kind of other dots and such, George, let's jump over here to the retail REIT side. What does this actually show when you have this red dot here? I mean, I see a bit of a description that pops up on the screen, but maybe you can help us out a little bit to explain that in a little more simplified fashion.
Well, sure. I mean, when it comes to the allocation effect, really the idea behind this methodology is that you want to be over-allocated to overperforming sectors, and then you want to be under-allocated to underperforming sectors in order to have a positive allocation effect. So in this case, if you look at the retail return, so the retail REITs had an index return of negative 10.73%. When you look at that return in relationship to the total index, the total return of the entire benchmark, so if you scroll down to the bottom, it's negative 0.38%. Or negative 0.78%.
Right, because we're only looking at the second quarter here. So, yep, go ahead.
Correct. So in this case, that sector underperformed the overall benchmark. So that's an underperforming sector. So that is what causes the bubble to turn red. So the fact that you are over allocated to that underperforming sector that's why if you look over to your attribution effect, you have a negative attribution effect of 0.78%.
Right. Right. That makes complete sense. And you can actually too, correct me if I'm wrong, George, you can actually get this on the graph out here, and it kind of gives you that bit of a breakdown as well.
Yeah, exactly. So on the left side, you have the chart that has all these numbers, but if you really want just a brief summary and simplification of what's going on the left side, that's why we have this bubble chart. The line in the middle shows whether you're over or under allocated to a sector, and then the size of the bubble shows really how much of your overall, how much you're weighted towards that property type. So in this case, you have a red bubble over allocated, and that's why it's on the right side. And it's red because it's an underperforming sector. So with even looking at the chart on the right, you should be able to tell that that red bubble is going to cause a negative allocation effect because of the fact that you're over allocated, and that sector, it's a red bubble, so it's underperforming the overall index.
Right. Yeah, and that's a great explanation, and I think that really is shown here when you kind of read the graph for the way it's kind of laid out. It's obviously on the over side here, and as you just explained, and the red bubble signifies that it's an underperformer. We can see that on the performance itself. Why don't we take a look at another example, George, and jump down to maybe the private equity side and look at Industrial West, and maybe give us an explanation again a bit on the green bubble and its impact as well. And I guess I have to maybe scroll down to just let everyone know again, because here's the returns, and if you want to take it from there.
Yeah. So in this case, if it's important to remember that 5.35%, that's the return of the index for the Industrial West. So that shows that because it's higher than the negative 0.78%, it's an overperforming sector, and that's why the bubble's green. So in this case, you're over allocated to an overperforming sector. So that's why if you look at your allocation effect all the way to the right side of positive 0.8%, it's positive because of the fact that it's an overperforming sector and you're over allocated.
Great, yeah, and that's great. That's obviously helping out their portfolio as well. And let's take a look at that up here, and that should be out here because again, as you explained, right, the over allocation. But as you can see here, the bubble's green, as George explained, which is good and positive, and has helped the performance of the entire portfolio.
Right, and then and what we're trying to do is that we're trying to explain through the attribution why it is that you either overperformed or underperformed the index. So if you scroll all the way to the bottom and you look at the return of this portfolio, it did overperform the index by 1.2%. So the portfolio itself had a positive return of 0.43%, the index of 0.78%, so you overperformed. And what we did through the attribution is break down between the different components, whether they positively or negatively impacted your overall performance. So if you were to add up all those different components on the right side, those attribution effects, it will add up to 1.21%, which is actually the difference between the performance of the portfolio versus benchmark.
So I guess to simplify it even more, you want positive numbers out here. Is going to signify, where you had that additional return to the fund performance. Hey, let's talk a little bit briefly here about the graph, because I think pictures always grab people's attention. So this is just the top 5 and bottom 5 sectors of the portfolio?
Correct. We do not have all the other bubbles there for everything from the fund, just because it'll look too convoluted. So really what we focused here on this chart was the top 5 and the bottom 5 sectors.
And can you give us a little explanation of why some of these bubbles are filled in and some are not?
Okay, so the ones that are filled in is because those are sectors that you actually have allocations to.
Okay.
The ones that are empty, it's really sectors that you do not have an allocation, but it's causing some type of negative effect or positive effect. Because you're not allocated to that sector, if it's within the benchmark, it's still going to show some type of effect at the end. So in this case, you more than likely have a positive contribution through attribution, because as you look at healthcare REITs, it's an empty red bubble. So that just tells me that it's an underperforming sector. And because you have no allocation, it's actually a good thing for your portfolio, because during that time period, it was underperforming. So the fact that you have no allocation or underallocated, just allocated to that sector, attribution is going to show as positive.
Yeah, now, I think that's a great explanation, George, because when you look at the returns, just a terrible quarter for healthcare REITs, down 10.8%. So here, without that allocation, you're just much better off, is what you're explaining.
Exactly. And it'll be the reverse for the other one. So if you look at that green bubble, the commercial financing REIT, in this case, you have zero allocation, so you're under allocated, but that was positive. That was a outperforming sector, so that had some negative effect on your portfolio.
Right. So I guess you have to understand when you look at that graph, and I've obviously learned from you on this, and I've seen it multiple times. I think that's where sometimes some of the viewers could be a little confused, because this is green and green is assumed to be positive. But in this case, it actually, without having that allocation and missing out on the positive returns, it actually had a negative impact because it's below and underallocated to the left. Correct, George?
Correct. You're underallocated, but that was an overperforming sector.
Right. So you missed out. So don't let the green and red fool you. You should just look at it and listen to George's explanation, because I think it makes a ton of sense when you start to play with it. Well, let me just ask you a couple other quick things here, George. And again, thanks for the time. Really, this is great for the fund. It's great for the teams to look and really see what happened. But really, when they're out there and they're getting into the real world, where do you see the use of tools like this and the Altus Analytics attribution analysis component?
Well, this is really an important tool really for portfolio management. It's something that when you know, you're going to learn to apply when you're making decisions, when you're making reallocations. Really, in the real estate world, as it increasingly becomes more transparent and more data like this is available, people are going to want to understand why it is that they underperformed, just so that they understand what it is that what next steps they're going to take. It's important to understand attribution. It's very retrospective. You're looking at it within a past period, but within all portfolio management, you really kind of have to understand what went right during that period. Then, what, based off your research, what do you think is going to be happening in the next few steps, and understanding how your properties and your decisions amongst your strategy are going to affect your overall returns. And again, through attribution, all we're trying to do is quantify the performances of your strategy and then your performance. And this is just a very important tool, especially when you go into the portfolio management world, as this data becomes more available.
Right. And I think that's a great explanation, and I think that's probably a great place for us to wrap up. So you learn this attribution tool. It's going to help you in your careers as you move forward in the finance or in the real estate fields. So on that note, let me thank again Jorge Paredes, CFA manager at Altus Group in our Chicago office. I'm Chuck DeRocco. I'm Director of Real Estate Research, again with Altus. Again, thanks, Jorge. I hope this tool and this explanation and the podcast was helpful to our participants, and wish you all good luck in the competition. Thank you.